Warren Buffett bought 130 million ounces of silver. Your bank says it's a bad investment. Someone's lying. 1997. Berkshire Hathaway files a 13F disclosure showing they've accumulated 130 million ounces of physical silver. Not silver mining stocks, not silver ETFs, physical metal. Bars sitting in vaults. This is Warren Buffett, the man who doesn't invest in things he doesn't understand. The man who avoided tech stocks during the dot-com bubble. The man whose entire philosophy is based on fundamental value. He's buying silver. Lots of it. At the same time, every major bank analyst covering precious metals was telling retail investors that silver was a terrible investment. Too volatile, no yield, storage costs, better opportunities elsewhere. The official line from Wall Street was clear. Silver is for preppers and conspiracy theorists, not serious investors. So which is it? Is silver a strategic asset worth accumulating in massive quantities? Or is it a bad investment that sophisticated people avoid? The answer reveals something important about how the financial system actually works and who it's designed to serve. Let me show you what the billionaires are actually doing, while the banks are telling you to do something completely different. Warren Buffett held that 130 million ounce position from 1997 to 2006, 9 years. He bought at an average price of $5.50 per ounce and sold around $7.50. A 36% return over 9 years. Not spectacular by Buffett standards. But here's what matters. He wasn't trading it. He was holding it. Physical metal. In a period when banks were telling everyone that precious metals were dead money, Buffett was accumulating and holding one of the largest private silver positions in history. But Buffett isn't alone. Let's look at who else has been accumulating silver while telling you not to. Bill Gates, through his investment vehicle, Cascade Investment, holds significant positions in silver mining companies, not through index funds. Through direct equity stakes in companies like Pan American Silver and Hecla Mining. When you invest in mining companies rather than ETFs, you're taking concentrated positions based on specific analysis. You're saying this sector matters enough to research individual companies and take large positions. George Soros, through Soros Fund Management, has repeatedly taken large positions in physical precious metals during times of monetary instability. His fund increased gold and silver holdings dramatically in 2020, during the COVID crisis, not as a small allocation, as a significant portfolio position. This is a man who broke the Bank of England by betting against the pound. When he buys physical metals, he's not making a casual diversification play. He's positioning for systemic change. Ray Dalio, founder of Bridgewater Associates, has been publicly advocating for gold and silver positions since 2019. Bridgewater's all-weather portfolio includes significant precious metals exposure. But here's what's interesting. Dalio talks about gold publicly, but rarely mentions silver specifically. Yet Bridgewater's filings show positions in silver-related assets. Why talk about gold, but quietly position in silver? Because silver is still under-discussed, still under-owned, still offering asymmetric opportunity. Stanley Druckenmiller, legendary macro investor, disclosed a $27 million position in physical gold in 2020. He didn't stop there. His fund also holds positions in streaming and royalty companies that have significant silver exposure. These aren't passive allocations. Druckenmiller is known for concentrated bets when he sees dislocations. His precious metals positioning suggests he sees a major dislocation coming. Carl Icahn, through Icahn Enterprises, has taken positions in companies with significant silver reserves and production. These aren't small positions. We're talking hundreds of millions of dollars in capital allocated to businesses that derive substantial revenue from silver. When activist investors like Icahn take large stakes, they're not gambling. They're acting on specific analysis that suggests significant value creation potential. So we have Buffett, Gates, Soros, Dalio, Druckenmiller, and Icahn. These aren't retail investors following Reddit threads. These are the most sophisticated capital allocators in the world. Combined, they manage trillions of dollars, and they're all, in different ways, positioning for silver. Now let's look at what the banks are telling you. Pull up any major investment bank's commodity outlook. Read their precious metals research reports. The consistent message for the past decade has been gold is okay as a small portfolio hedge, but silver is too volatile, too industrial, too speculative. They recommend 0 to 2% allocation to precious metals, with emphasis on gold, not silver. Morgan Stanley's 2023 Precious Metals Outlook recommends gold, cautious on silver due to industrial demand concerns. Goldman Sachs 2023 Commodities Report, bullish on industrial metals, neutral on silver, sees limited upside. JP Morgan Precious Metals Strategy, gold preferred over silver for portfolio allocation. Every major bank is telling retail clients to avoid or minimize silver exposure. But what are the banks themselves doing? Let's look at the actual data. JP Morgan's commodities desk has been one of the largest accumulators of physical silver over the past decade. Between 2011 and 2020, JP Morgan reportedly accumulated over 150 million ounces of physical silver in COMEX-registered vaults. They were buying while telling clients silver was a weak investment. In 2020, JP Morgan paid a $920 million fine to the Department of Justice for manipulating precious metals markets. The manipulation? Spoofing orders to drive prices down while they accumulated physical metal. Let me be very clear about what this means. JP Morgan traders were placing large sell orders they had no intention of executing, driving the price down, then canceling those orders and buying physical silver at the artificially depressed price. They were prosecuted for this. They paid nearly $1 billion in fines, and they kept the silver. Think about that. The cost of the manipulation was $920 million in fines, but they accumulated 150 million ounces of silver. At today's price of $24 per ounce, that's $3.6 billion worth of silver. They paid $920 million in fines to acquire $3.6 billion in assets. That's not a penalty, that's a transaction cost. This is the game. Banks tell you silver is bad. Banks manipulate the price down. Banks buy physical silver. Then banks tell you to sell when they want to accumulate more. But it's not just JP Morgan. HSBC has been a major player in silver vaults. Bank of America has faced similar allegations of precious metals manipulation. These institutions controlled a paper market through futures and derivatives while accumulating physical metal through their trading desks. Now let's talk about where all this silver is going, because it's not sitting in retail investors' safe deposit boxes. It's going into private vaults. Ultra-high net worth family offices are building precious metals allocations at levels that would surprise most people. Private vault operators report that demand for allocated precious metal storage has increased 340% since 2019. This isn't crypto investors diversifying. This isn't middle-class savers buying coins. This is serious money. Minimum account sizes at premium vault facilities are typically $1 million. These facilities are expanding capacity to meet demand from family offices and billionaires who want physical metals outside the banking system. Switzerland, traditional hub of private precious metals storage, has seen massive expansion of vault capacity. New facilities opened in Singapore, Dubai, and New Zealand specifically to serve ultra-high net worth clients seeking allocated storage of physical metals. When you're building billion-dollar vault facilities, you're responding to real demand from people with serious capital. The data from these facilities shows an interesting pattern. Gold to silver ratios in private vault holdings have been shifting towards silver. 5 years ago, typical allocation was 90% gold, 10% silver by value. Now it's closer to 75% gold, 25% silver. Wealthy families are deliberately increasing silver exposure beyond traditional portfolio weights. Why? Because they understand something the public doesn't. They understand that silver's dual role as both monetary metal and industrial metal creates asymmetric opportunity. They understand that the silver market is small enough that large positions can be accumulated at reasonable prices. They understand that industrial demand for silver is accelerating in solar, electric vehicles, and electronics, while mine production is declining. Most importantly, they understand that fractional reserve silver means most silver held by institutions doesn't exist as physical metal. When the system breaks, when everyone tries to convert paper to physical, the people who already hold physical will be positioned correctly. The people who hold paper will be creditors of institutions that can't deliver. This is why billionaires buy physical while banks recommend paper. The billionaires want the metal. The banks want to control the metal while selling claims against it to retail investors. Let me show you the specific vehicles wealthy investors use versus what banks recommend to you. When Buffett bought silver, he took delivery of physical metal and stored it in allocated vaults. When you buy silver, your bank tells you to buy SLV, the paper ETF where you can't take delivery. When Ray Dalio positions in precious metals, he uses funds that actually hold physical metal with redemption rights. When you try to position in metals, your advisor recommends mining stocks, which have operational risk and don't give you exposure to the metal itself. The wealthy buy allocated physical metals stored in private vaults outside the banking system. You're directed to unallocated bank accounts or paper ETFs where you're a creditor, not an owner. This isn't an accident. This is the system working exactly as designed. Banks profit from this structure in multiple ways. They earn fees on the paper products they sell you. They earn interest lending your silver to short sellers. They profit from the bid-ask spread between paper and physical. They benefit from volatility that scares you into selling, allowing them to buy physical cheaper. Every part of the system is designed to keep you holding paper claims while sophisticated money accumulates physical metal. Here's the part that should make you angry. When the 2020 COVID crisis hit and physical silver premiums spiked to $10 over spot, wealthy investors with allocated physical metal didn't care. They already had the metal. The premium affected people trying to buy physical, not people who already owned it. While retail investors scrambled to convert paper to physical and faced massive premiums. Billionaires sat on stockpiles they'd accumulated at lower prices when banks were telling everyone silver was a bad investment. This is wealth transfer through information asymmetry. The people with capital and knowledge accumulate assets when they're cheap and unpopular. Then the asset becomes popular. Retail investors rush in and buy paper at inflated prices. And wealthy holders sell their physical metal to institutions who need it to back the paper claims they've sold. The retail investor ends up holding a paper claim while the billionaire moved his capital to the next undervalued asset. So when your bank tells you silver is a bad investment, understand what they're really saying. They're saying it's a bad investment for you to hold physical silver that you actually own. Because if you own physical silver, you're not generating fees for them. You're not providing deposits they can lend against. You're not participating in the paper market they control and profit from. But it's an excellent investment for them to accumulate physical silver while driving the price down through manipulation, and then position that physical metal against the paper claims they're selling to you. Warren Buffett, Bill Gates, George Soros, Ray Dalio, these men didn't become billionaires by making bad investments. When they buy physical silver and hold it outside the banking system, they're telling you something. When banks tell you the opposite, they're also telling you something. The question is, who do you believe? The people with capital who are quietly accumulating metal? Or the institutions that profit from you holding paper claims instead of physical assets? Your bank has a conflict of interest. The billionaires don't. Their money is on the line. Yours is too. But only one of you knows what you're actually holding.